from looking at their SEC filings, their 10K and 10Qs, which are accounting reports that they provide to the SEC on a quarterly basis. But I just thought we'd take a look at the annual financials of this business. At the end of 2007, the net revenues for Lehman Brothers was $19 billion. This is a firm that earned $19 billion in revenues in 2007. We're not talking about a small little shop here. This is a major financial institution. And if you look at their profits, their net income, $4 billion of net income in 2007. And 2007 was not a great year. So $4 billion of income is a pretty impressive number. And if you look at their long-term capital, the capital base, we're looking at $145 billion. And if you take a look at their assets under management, the assets under management in billions is $282 billion of assets under management. Now, at the end of 2007, would anybody have forecasted that a company like this could be gone 9 months later? Gone. I mean, just obliterated. 28,500 employees. So we're talking about major disruption to the New York workforce. A number of people are going to be looking for jobs. Now, a number of jobs are going to be created as a consequence of these dislocations. I'll come to that in a minute. But this is an extraordinary set of events. And one key to what's going on and why this might have happened is this number right here, the net leverage ratio. That net leverage ratio tells you something about how much exposure Lehman Brothers had relative to how much capital they're actually managing. And let me give you an example of what I mean by that. And I'm going to give you a personal example that we're going to come back to. We talked about mortgages last time, and I told you all that you now had the power to compute mortgage payments. Well, you know that a mortgage is a loan, right? You're borrowing money from the bank to buy this beautiful home that you want to live in. Does anybody know how much money you typically have to put down when you buy a home? Yeah. 20% is the typical number, although in recent years, it's much less than that. For example, when I first bought my home way back in 1988, my first home, when I moved here to Boston, I actually only had to put 5% down because I was able to get a jumbo loan and, in addition, purchase mortgage insurance so that the bank was willing to lend me quite a bit more than they usually would. Now, let's take the 20% down as the standard number, because that is absolutely industry standard. If you put down 20% for, let's say, a $500,000 home, which in the Boston area is a little starter home, I'm afraid, a $500,000 home, you put down $100,000, and the bank lends you $400,000, the value of your total assets is, of course, $500,000, right? You've got $100,000 of your own money, $400,000 of the bank's money, and with that $500,000, you give it to the other party to buy the home, and now you are the happy owners of a $500,000 home. What kind of leverage ratio do you have in that circumstance? Anybody calculate that quickly? Close, but no cigar. 5 to 1, right? 5 to 1 in the sense that you have 5 times leverage. Your total exposure is 500. You've got 100. It's 5 to 1. Now, what does that mean, 5 to 1 leverage? That sounds scary. That sounds like you are really levered up. Well, it's only scary if the value of the assets swings around a lot. For example, let's do a simple back-of-the-envelope calculation. Suppose house prices fall by 10%. That's only 10%, right? That's not a huge number. It's significant, but it's not huge. What's the return on your investment? How much have you invested in the home? $100,000. If the value of the home falls by 10%, how much has the value of your assets fallen by? $50,000, right? Of that 50,000, how much does the bank lose? None, right, because they've lent you money and they expect you to pay it back. They're not equity holders. They're not looking to take on any downside risk. They just want their money back with interest. So the bank doesn't care what the value is. They still expect you to pay back their $100,000, the $400,000 that they lent you with interest. So that $50,000 loss, it's all yours. And you put down 100,000 and you've lost 50, half of your assets just got wiped out with only a 10% move in the value of the home. Now, instead of putting 20% down as a standard, what if you did what I did, which is you put down 5%. So 5% of $500,000 is $25,000, right? The bank lends you $475,000. So this is not a conforming loan. It's you've got to buy insurance, and it's subprime, so on and so forth. 5% is your investment, $25,000. Now, suppose housing prices go down by 10%. What's the return on your capital? Well, you've lost everything, right? The $50,000 loss is still there, but you only put in 25. So you've now lost all of your capital, and on top of that, you're in the hole for another 25. So you've actually lost not only all of your wealth, but actually you've lost more than all of it. You've lost minus 100% of your wealth, or your total return, your net return is minus 200%. So if you're a major financial institution and you're leveraged 16 to 1, and the value of that portfolio declines by 10% or 20%, you can go through capital very, very quickly. Now let's do a back of the envelope. The amount of capital that they have, let's go up and take a look at this. The amount of capital that Lehman had is something like total long-term capital, 145 billion, okay? If you leverage that 16 to 1, and then you ask the question, with that leveraged amount of capital, if it drops by, I don't know, 10%, 5%, 7% of that total asset base, you can see how you can go through 145 billion of capital pretty quickly with leverage. Now you might ask, why on earth would anybody do this? Why would you leverage 16 to 1? Well, why would anybody buy a house in New England with 5% down? That's just as crazy. What's the leverage ratio if you put 5% down? 20 to 1, exactly. So I was a proud leveraged investor that had 20 to 1 leverage. I beat Lehman Brothers. Why would I do that? Is that insane? Well, yeah. Well, yes, that's a very polite way of saying it. Yes, I would tie up too much capital if I didn't do that, but the fact is I didn't have the capital. So thank you for being kind. But why wasn't it nuts? Yeah. Exactly. If the value goes up, then I earn that kind of money, the same kind of money. So if housing prices go up by 10%, then at 20 to 1 leverage, I look like a hedge fund manager, right? Make a ton of money. But that's not the only reason that I'm willing to do that, because you're saying that I want to take that risk. Why would I do that? Yeah, Michael.
Well, your risk seems very low.
Why?
Well, in the past, there was nothing to indicate that prices would go down.
Exactly. The risk of 20 to 1 leverage is only a risk if the amount of housing price fluctuation is such that it could actually wipe me out. But up until very recently, housing prices have done nothing but this. They've gone up. And not only have they gone up, they've gone up in a very smooth and orderly fashion. You know, if house prices went up by 15% a year, every year, you might be thrilled, but also a bit scared. That's not what happened. Housing prices have gone up maybe, I don't know, 8%, 10%, 7%, 5%, 6%. It's been relatively smooth. And so the volatility of those kinds of investments were low enough that the leverage didn't scare me at all. And in fact, I didn't lose money. I held that house for about 5 or 6 years and bought another one, and it was fine. It was fine because that kind of leverage is not a problem as long as the volatility of the overall investment wasn't out of hand. What happened over the last 2 or 3 years is that the volatility has gotten out of hand. And we're going to talk about that Wednesday at that pro seminar. I'm going to give you a concrete illustration, not only of how it got out of hand, but how financial engineering and the design of derivative securities to expand the housing market and provide people with these loans exacerbated the problem on the downside. But of course, the purpose of it was to help people on the upside. It's exactly looking at the investments going up and thinking that, gee, they can never come down. Yeah, question?
What about the fact that at the end of the day, you can live in your house and the whole valuation of your house, if it goes down $100,000, it's still a first view away.
Right.
So you don't really have to deal with the mark-to-market of your house.
That's a very important point. The mark-to-market. What does mark-to-market mean? Anybody know? We've never used that term in class so far. Yeah.
Something that's in book value gets matched against reality.
That's right. When something that may have a book value gets marked to a reality check in terms of market price. So for example, the first lecture where I auctioned off that little tiny box that you had no idea what was in there, it had no market value beforehand, at least not to any of you, but we marked it to market. We marked it to market at 45 bucks. And so it established a market price. Now the question is, who cares what the value of the house is? You're living in it, you're enjoying it, so what's the big deal? Well, that's right. It's not a big deal if you enjoy living in the house and you can afford to pay the mortgage and you're okay. And millions of homeowners are exactly in that situation. So we can't forget that the subprime mortgage has enabled literally millions of homeowners to become homeowners who never could have. But what if there's a problem in terms of interest rates going up and your mortgage payment going up because you ended up getting a very low teaser rate for your mortgage? You got an adjustable rate mortgage because they said, gee, you can buy this house with virtually no money down, and you've got plenty of resources to be able to pay for it because your payment is only $300 a month. And then a year later, that mortgage payment is $1,000 a month, and then it's a real problem. Okay, then you've got a decision. The decision is, are you going to keep paying all of your income and have a hard time making ends meet for a house that you will never get the money back? It's literally taking your money and burning it because you've lost your equity and you've lost so much more beyond your equity that in order to make money, you'd have to hold on to the house for 20 years and you can't afford the house anyway. Do you do that? Or do you put the key in the front door and move out and say, you know what, bank, it's all yours. I'm moving on. That's what's happened across the country. It's the fact that people can't afford these mortgages because they got in at low teaser rates, and now the rates have come up because the interest rates have been going up. Now, something very significant is going to happen tomorrow. Tomorrow, the Fed is almost surely going to cut rates because they want to reduce the pressure on the system for exactly these kinds of issues. They want to reduce the kind of default rates, and by keeping interest rates low, they actually are going to be able to encourage liquidity and reduce the kind of pressure that we've been seeing. Yeah, question.
So I was going to ask, what happens if you put your 5% down, the value of the house goes down, say 25%. It's been only a year. You feel like you're not going to get. It's never going to come back up. Can you literally just go to the bank and say, it's yours?
Well, that depends on what you signed when you got your mortgage from the bank. Most mortgage contracts are known as non-recourse loans, meaning that they've got your house as collateral, but that's all they've got. They don't have your firstborn. They don't have your pinky finger. And depending on where you borrow, in some cases you may have to give that up. But no, the fact of the matter is the most they can do is take your house away and sell it. And a lot of homeowners are saying, great, it's all yours. I'm moving out of Stockton, California. I don't need the house. I don't need to have these mortgage payments where I'm throwing in good money after bad. That's their perspective.
What about your credit score?
Yeah, so your credit score will go to hell. So you'll wait. So you'll wait 5 years or 7 years, and then you'll, be back again. There's a finite limit on, how long they can keep those kind of credit scores, and beyond a certain point, you will have a clean record. But even with that bad credit score, I mean, don't forget, that's how the subprime mortgage market got created. You saw the TV ads, right? Doesn't matter if you're in default, doesn't matter if you have no credit, doesn't matter if you don't have a job, we'll still give you a loan. Now, that's not true today, or not as true today, but at some point when the market recovers, we're going to see that come back again. And so you will be able to borrow again. Okay? Yeah?
Given that the interest rates are now going up, does that mean that those that
Going down.
well, or maybe despite the fact that the Fed cut the reserve rate or whatever,
Yeah.
the actual interest rate that homeowners are paying
Yeah.
hasn't changed.
Right.
So does that mean that those with good credit are effectively subsidizing those with bad credit?
Well, yes and no. I mean, I think that the subsidization that you're talking about really happens very, very indirectly. The fact that there are large numbers of defaults ultimately may mean that it's harder to get a subprime loan. So the folks that are actually good credits but don't meet the prime borrowing rate criteria, yes, they will suffer. But in equilibrium, by equilibrium I mean when supply equals demand, the price is the price is the price. So, it depends on, what kind of a borrower you are, but whatever type of borrower you are, if you can signal that that's the type you are, you will be able to get that appropriate kind of credit. All right. So in that sense, it's not as if taxpayers are footing the bill for the particular interest rate shifts that are going on. Taxpayers may end up footing the bill for what happened with Bear Stearns, what happened with Fannie Mae and Freddie Mac, and that's one of the reasons why over the weekend, when the Fed was approached by Lehman Brothers and say, hey, you got to help us out here, the Fed said, you know what, we're done with that. Sorry, but we can't ask the American taxpayer to foot this bill either. Otherwise, there's going to be tremendous backlash. And so when Lehman Brothers was left without backing from the Fed, they went to a number of private organizations like Barclays. Barclays said that they would be willing to do it if the Fed was able to provide some kind of backstop. The Fed was not willing to provide a backstop, so Barclays said thanks, but no thanks. And at that point, Lehman said, we have no choice because we cannot close a sale within a matter of 24 to 48 hours from this point on, and we've got some notes coming up. We've got to do something, so they filed for Chapter 11. Yeah.
When they cut the rates more, they do. What's the negative part? Inflation? Or?
Yes. We're actually going to talk about that in the next lecture, in this next segment. Inflation. If the Fed cuts rates, one could argue that the reason we're in the mess that we are is because the Fed had kept the Fed funds rate so low for so long that even after the stock market crashed with the internet bubble bursting, the housing market continued on with its bubble because it was still so cheap to borrow. And I'm sure I mentioned before that when I was an assistant professor at the Wharton School back in 1986 looking to buy a house, the 30-year fixed was at 18%. 18% for a 30-year fixed mortgage. I didn't do it because I couldn't afford it at the time. But think about that versus today. Mortgage rates are maybe at a recent high of 6, 7, 8%. That's not bad relative to historical standards. Okay. So yes, I mean, I think that's the concern, that if we keep interest rates too low, that's going to encourage inflation. And inflation will have its own costs. Anybody who's from a kind of any Latin American country will know the ghost of inflation is tremendously frightening, and we don't want to let that get out of hand. If you remember back to the 1970s, we had some inflation in the U.S. that was a real problem. So we're going to talk about that in just a couple minutes. Any other? Yes.
I mean, just one thing that you mentioned is funny to me, that you said that when the market comes back, we will still have another bubble.
Absolutely. Yes.
But I mean, do you think this is reasonable?
Do I think it's reasonable? You see, you're not allowed to ask that question to an economist. Or rather, an economist is not allowed to answer that. Reasonable is relative. and there are moral and ethical overtones that economists don't like to get involved in. It's human nature. Is it human to suffer from fear and greed? Well, yes, and I don't think I'm going to change that anytime soon, nor are you going to be able to change that anytime soon. So that's one of the reasons why we study finance, is to develop an intellectual and disciplined framework for thinking about these issues. Because if you don't have a framework for thinking about this, then you're left responding to fear and greed. Right now, we are in the absolute grips of fear. Those of you who aren't in financial markets, if you read the papers, my guess is you'll start getting scared anyway. And if you're in financial markets, I promise you, this is the scariest time that we've been in, including August of '98, October '87, '94, 2001. All of the kind of periods of market dislocation is trumped by what's been going on over the last few weeks. And it's exciting from the point of view of being a finance student, because you actually have the opportunity to understand and do something about this. But it requires a certain discipline to do that. Yeah, Ingrid.
What does exactly mean that Lehman goes bankrupt? Because everybody, like, I guess it's not a retail bank, right? But if I have some money deposited there, will they give it back to me because I am a liability to them?
Well, that's exactly the problem. The answer is I don't know. And that's one of the reasons why there's this dislocation. Nobody knows, because nobody knows how large the losses could be. And part of the thing is that the losses at Lehman and other financial institutions, including Merrill Lynch in some ways has bigger exposure than Lehman. The difference is that Merrill Lynch has other sources of revenue that are able to let it get through this situation a bit more gracefully. But the problem is we don't know, because we don't know how the value of these large assets are going to be valued. If you value them at zero, then they're in deep trouble. And not only are the shareholders going to get wiped out, but a lot of the creditors are going to get wiped out. If you value them at what they're valued now, well, then there are going to be some hiccups along the way, but a number of people should get out without, outrageous losses.
And can't you sort of declare default, stop paying now,
Yes.
and wait till things get better?
Well,
Okay, I'm sort of applying my Latin American experience here.
Yes. I mean, that's exactly what filing for bankruptcy does. When you file for bankruptcy, you basically go to the courts and say, I cannot make good on my IOUs. And I recognize that this is a problem, so I'm going to ask the court to appoint a conservator or a supervisor to oversee the disposition and dissolution of my assets in order to make an orderly transition to pay off all of the creditors. And you know who's last in line? The shareholders. That's right. So most people think the shareholders are going to get nothing, which is kind of astonishing, because take a look at their closing price in 2007. The closing price of Lehman Brothers stock, $62 a share at the end of 2007. 9 months later, it's worth zero. From $62 a share. That's a huge destruction of value. And you know what? Part of that loss in value is really due to the loss of brand and the loss of business viability. It's intangible assets. It's not like all of a sudden the Lehman investment bankers and proprietary traders and asset managers, all of a sudden they had brain damage and they're a lot stupider than they used to be. They're just as smart, just as savvy, just as experienced, just as knowledgeable as ever they were. The problem is that because of the magnitude of their exposures, there's general concern about their viability as a business. And when you don't want to do business with them, when everybody doesn't want to do business with them, when nobody wants to do business with them, they're not a business. And the value of their business goes to zero. And so there's a chicken and egg problem. And the bottom line is that, irrespective of whether it's the chicken or the egg, when the egg breaks, you're done. Yeah.
Is the story similar with Bear Stearns in terms of the leverage ratio being extremely high?
Yes. What happened with Lehman is quite similar to what happened with Bear, except that with Bear, there was a rush on its, there was a panic that was triggered by what seems to be some kind of a rumor, not necessarily large exposures coming due. Bear Stearns actually had funds that were engaged in these kinds of subprime mortgages, CDOs and CDSs. Those funds went under during the summer. But Bear Stearns as a business collapsed because individuals really didn't want to do business with it because of this kind of a risk. And the same thing happened at Lehman, except Lehman's exposure was much larger. They have much larger exposure to these markets. They're one of the biggest players in these particular kinds of securities. Okay, let me just, because we're running short on time, I'd like to just take one more question, and then let me go on with our lecture. And believe it or not, we are going to cover material exactly related to this when we start talking about fixed income securities. So this is very much apropos. Yeah, Rami?
Well, how do you think this affects us in terms of the people that want to do financing?
Yeah, great question.
25,000 people from Lehman competing for the same jobs
Yeah.
from Maryland.
Absolutely. So this is a great question. I'm actually going to talk about that specifically Wednesday evening, but let me give you the short answer now. The short answer is that within the next 2 or 3 months, Wall Street will be frozen. They're going to be a deer caught in the headlights. They won't know what's going on. They won't know what their hiring plans are. They won't know the number of slots they have. They won't know if there's resumes flying back and forth. So it's going to be a bit of chaos for the next 2 or 3 months. It's not clear that that's going to affect you because internships still have to be filled. Entry-level positions are actually the least of least concern to businesses because those are the ones that they want to fill because the new generation are hungry and smart, ready to do anything, take on anything, and cheap. That's right. I didn't want to say that, but you said that, so. Good value, let me put it that way. You're good value. And so what's going to happen is it'll be virtually impossible for a senior managing director from one firm to easily get a job at another firm within the next 2 or 3 months until things settle down. At the entry-level job market, I suspect that there will be some disruption. For example, just a simple indication of that, today, after my 4 o'clock section, I was supposed to meet with the CFO of Bank of America, Joe Price. As many of you know, we established a relationship with Bank of America just recently, the Laboratory for Financial Engineering, to work with B of A to do some interesting research and to get access to their tremendous database. And we were going to launch that set of discussions today with Joe Price. Not surprisingly, at 3 in the morning, I got an email from a B of A employee saying that he will not be coming to MIT today after all. He's a little bit tied up. By the way, B of A also looked at Lehman over the weekend. So over the weekend, B of A folks were pretty busy shopping. They looked at Lehman, but again, when the Fed wouldn't guarantee any kind of a backstop for Lehman, B of A passed as well. So that's an example of the kind of dislocation I'm talking about. There'll be scheduling glitches and things like that. Going forward, though, after the 2 or 3 months, I actually think this is a fantastic time to get into the industry because when you have these kind of dislocations, opportunities get created. And opportunities for people that are smart, that are hungry, that are willing to work hard. I mean, that's exactly the kind of situation that you want to be in. When things are going well, they don't need you. They're going to hire people just to be clerks and to get people lunch. But now is the time where you can actually have a big impact. So rather than be discouraged, I think all of you had perfect timing in terms of being in school now. In 2 years' time, you'll get out. That's when all of the businesses are going to be recovering and certainly doing quite well, I suspect. And even within the next 6 months, you're going to see that a number of firms are going to be hiring. And by the way, the dislocation we're talking about is on the broker-dealer side. On the asset management side, hedge funds, pension funds, asset management companies, foundations, endowments, non-financial corporations, they're hiring and they need people with financial expertise to deal with these kind of market dislocations. So I think that the job prospects are actually quite bright for this class and the class after. The folks that are going to be in a little bit of a tough bind are the second years who will be interviewing for their jobs in the next 2 or 3 months. They may end up having to wait a little bit longer, and I suspect that they will take a little bit longer to settle on their jobs. But even then, MIT students end up having a bit of an advantage over other MBAs simply because of the expertise that we bring to the table. Okay. So sorry about taking up so much of your time, but I think this is relevant and it will be useful for what we're going to be talking about next. Let me now turn to let me turn to what we ended with in the last class, which is the inflation topic. Last class, you recall, we talked about the two formulas that you're going to know very well by the end of this course: perpetuities and annuities, and compounding. And where we ended with was this notion of inflation. How many of you already know what inflation is, and you've talked about it in macro? Okay, some of you. So let me go over it briefly, and I think you'll see very quickly exactly what the idea is. It's really meant to capture the fact that the purchasing power of your money can vary over time, irrespective of the time value of money. And let me explain it this way. At a particular point in time, let's say time t, you've got a certain amount of wealth, WT. And the value of the kinds of things that you like to buy is given by an index, call it I sub t. So you can think about that as the price of the basket of goods that you enjoy. Okay? So this will include consumer items, food, clothing. As well, it may include other items, leisure, entertainment, and so on. And the fact that you have a certain amount of wealth doesn't really tell you how happy you are. It's really how much you're able to consume, how you use that wealth that tells you how happy you are. So economists really like to focus not on total wealth as a measure of your standard of living, but how you're able to consume that wealth. So we're going to come up with a basket of consumption goods and call that price of that basket I sub t, all right? Now let's move from time t to a different point in time, t plus k. So k periods from now, you're going to have a different amount of wealth, hopefully bigger, and presumably you're going to be able to consume more. Well, that's presuming that the prices of what you like to consume don't change. But if those prices do change, then in fact, you might not be really better off in any way. And so in order for you to tell whether or not you're better off or worse off, you need to know not only how much wealth you have, but how much that wealth can buy you in terms of the stuff that you like to consume. So the idea behind inflation is to measure the purchasing power of your dollar. And that's completely different from time value of money. Time value of money simply says that people are impatient and they prefer money now to money later. But inflation is a comment about the purchasing power of that dollar now versus later. And it can go either way. In other words, it's possible that $1 next year will buy you more than $1 today, because if prices decline, as they have right now for energy, for example, energy is below $100 a barrel. Just a few months ago, it was at $130 a barrel. So if we had a winter a few months ago, that would have been really bad, because home heating oil would have been a lot more expensive than it looks like it's going to be. However, it's still going to be more expensive than it was 2 years ago when oil was at $40 a barrel. So you need to know what you're going to consume in order to get a sense of whether you're better or worse off. And that's what we measure by this price index, I of t plus k. So when you're looking at your portfolio, you might ask the question, what's my return on my portfolio? And the way you calculate that return is look at your wealth at time t plus k, divided by your wealth at time t, subtract 1 from it, and that's your return, right? That's often called the nominal return because it's in name only, meaning it's the actual number of dollar bills that your wealth will grow to. So if you've got $1,000 this year, next year you've got $1,100, your nominal return for your wealth is 10%. That's the number of dollar bills you have more than you had this year, 10% more. Now, if you want to know how you're doing in terms of your level of happiness, your purchasing power, your cost of living, your standard of living, you've got to look at what's going on with the cost of living increase, I sub t plus k divided by I sub t. And we can write that as a fixed growth rate pi per year. 1 plus pi to the k. So let's suppose that all the prices of the things you love and enjoy, they go up by 10% as well. Well, then have you made any money? Have you made any progress? You've made money, but you haven't made progress. You've made 10% in terms of your return on your initial $1,000. But the stuff that you like to eat and buy and use, that's also gone up by 10%. So in fact, you can't do any more consumption next year than you could have this year. Because while your wealth went up by 10%, the cost of living went up by 10%. So from a real perspective, real meaning what you really care about, you haven't really made any progress. Inflation is a measure of how much progress we've made. And so when you engage in analysis of these kinds of present value problems, you've got to ask the question whether or not you're focusing on nominal returns or real returns, okay? And ultimately, as a consumer, what you all care about is real returns. You want to know whether you're getting better off in terms of what you can really consume. So, how do you do that? Well, first of all, you have to change the units. Oh, sorry, question? Yeah. Why that letter? Oh, no, I'm sorry. Yeah, this is, thank you for pointing it out. No, by pi, I just mean a variable name called pi. I don't mean 3.14159. Only at MIT would I get that question. I've taught at other universities, and they ask me what that funny looking symbol looks like. So yeah, sorry about that. This is just a Greek letter that denotes a variable. It's like R or something. All right, thank you. So here, what I've done is to define a variable called your real wealth at time t plus k. Real meaning this is what you really can do with your money in terms of consuming. What it is your nominal wealth divided by the rate of inflation. So in the case of the example I gave you, where your nominal wealth goes up by 10% and your inflation rate goes up by 10%, when you take your nominal wealth and you divide it by that growth rate in inflation, what do you get? You get $1,000. In other words, your wealth hasn't changed in real terms. Okay? So in the example that I gave you, your wealth went up by 10%. Your inflation rate for a year is also 10%. So if you divide your total wealth by that index, you're basically going to get back to your original amount of wealth, right? So here's the general framework. Your real wealth is going to be your nominal wealth divided by the rate of inflation. You're dividing by it because you're using as your units of comparison today's consumption basket, right? And so the way you can look at your real return, which is denoted 1 plus r real to the kth power, your real return over k years is equal to the real wealth at the end of your k years divided by your wealth today. That's your real rate of return, right? Because it's how much real dollars you have at time k. That's just given by your nominal rate of return of your wealth, and then divided by the rate of inflation. Okay? So this is the expression that is the basic relationship between real and nominal consumption goods. And then we approximate this ratio with this very, very simple relationship here. The real rate of return is approximately equal to the nominal rate of return divided by, or minus the inflation rate, not divided by anything. That's the approximation. So getting back to my example of if you have a 10% nominal growth rate for your investment and you got a 10% inflation rate, then in that case, there's no approximation. In fact, your inflation rate, your real rate of return is 0, right? 10% minus 10% is 0. Where the approximation happens is when you have something a little bit different. For example, suppose the inflation rate were 10%, and suppose your nominal rate of return was 15%. According to this approximation, what's your real rate of return? 5%, right. It's not exactly 5% because if you take 1.15 divided by 1.10, it's not exactly 5%, but it's approximately equal to that, okay? What this says is that you ought to think as a consumer not just about the total dollars that's growing, but the purchasing power of those dollars. Okay. For the purposes of doing NPV calculations, I want to just mention one rule of thumb that will do you in good stead no matter what kind of calculations you do. And that is simply to keep track of whether you're using nominal or real cash flows, and then to use nominal or real discount rates to match. In other words, nominal cash flow should be divided by nominal discount rates, and real cash flow should be denominated by real discount rates. Most of the cash flows that you will get in your analysis will typically be nominal. Nominal meaning that's the actual number of dollars you will see on those dates. But occasionally you may get a forecast that is made in real terms, in terms of purchasing power. And in that case, you have to just be careful to use the right interest rate when you're doing your discounting. You have to take into account inflation. Nominal gets discounted by nominal. Real gets discounted by real. That's all you have to remember. Okay? Any questions about that? Okay. We're now done with lecture 3, and we're moving on to lecture 4, which is fixed income securities. And this is the focus of much of the dislocation in markets today. So this is very topical and something that I think you'll find very useful when we start trying to understand exactly what's been going on in these markets. Let me start with a little bit of an industry overview. And the industry overview will give you a sense of why these markets are so important as well as so large. Okay, so we're going to start, as I said, with an overview of markets and the participants. And then I'm going to talk about valuation of fixed income securities. It turns out that all of the hard work that we've done just over the last 3 lectures are going to be able to get us through all of valuation for fixed income securities. In other words, you now know all that you need to know to price virtually any fixed income security without default, without uncertainty. Remember, we said no uncertainty, right, until lecture 12. But that's a pretty significant accomplishment because there are lots and lots of securities out there that are fixed income securities. And you now have the tools. You don't know that you have the tools yet, but you do, believe me, you have the tools to price them all. So we're going to go over the valuation principles and apply them to discount bonds and coupon bonds. And then I'm going to talk to you a little bit about uncertainty. I want to bring in interest rate risk in a very simple way. I want to simply talk about the fact that interest rates do change over time, and that change can actually cause some concern as well as some opportunities. I want to discuss what those opportunities and concerns are. And then I'm going to conclude by talking about default. I'm going to talk about corporate bonds, and I probably won't talk about the subprime issues in this class because I want to focus on the material that's required, but I will talk about it in this pro seminar, which is optional, so you're welcome to come on Wednesday, and we'll go over that material. And if you want, you can take a look at it yourself. It's pretty self-explanatory, so I think you'll see how it goes. For readings, I'd like you all to read chapters 23 through 25 of Brealey, Myers, and Allen. You'll have 3 lectures to do that. Lectures 4, 5, and 6 will all be focused on fixed income securities. So let me talk to you a bit about the industry now. The name fixed income securities means exactly what it says. What we're going to do now is to focus on pieces of paper where the payoffs are fixed and known in advance. unlike a stock where you buy a stock and you don't know whether it's going to pay off at all, and the cash flows, the dividends, or repurchases or capital gains are uncertain. You don't have any idea what the cash flows may or may not be. In contrast to those securities, fixed income instruments have fixed incomes. So they have very, very clearly stated payoffs that you know in advance. So from a pricing perspective, these are probably the simplest kind of securities that could possibly be constructed, right? Couldn't be simpler than a piece of paper that says, every year on this date, I will pay you $10,000 of nominal currency, right? That's a fixed income security. Examples are anything from Treasury securities, securities issued by the United States Treasury and other foreign treasuries, to federal agent securities, we know about those now, right? Fannie Mae and Freddie Mac securities, to corporate securities, securities issued not by the government or by government-sponsored entities, but by private corporations and public corporations. And then municipal securities, these are securities issued by local governments. And then mortgage-backed securities, securities that are payoffs of pools of other securities, including mortgages. And then the whole mix of collateralized debt obligations, collateralized loan obligations, credit default swaps, and other complex instruments. That's a lot of securities. And to get a sense of how many securities we're talking about, let me show you the market. This is as of the end of 2006, because that's the only data that I could get that is as timely. At the end of 2006, the US bond market consisted of just tremendous amount of assets. So 6.4 trillion in mortgage-related securities, 24% of the market, 2.3 trillion in municipals, 4.2 trillion in treasuries, 2 trillion in asset-backed securities, 3.8 trillion money market, 2.6 trillion in federal agency securities, and so on. These numbers, they dwarf the stock market. So we're traditionally focused in financial analysis on pricing stocks and analyzing stocks, and we get all excited when Google tries to take over Yahoo and so on. But the size of the markets, the size of equity markets are dwarfed by fixed income securities. And again, these are apples and oranges, and I'm just saying that there's a hell of a lot more apples than there are oranges. You can figure out what you want from that, but these are really big markets. And on this slide, I show you the evolution of these markets, how they've grown over time, from 1985 to 2006. And what you'll see is that the mortgage-related market has just grown by tremendous amounts, as well as federal agency securities. That's Fannie Mae and Freddie Mac. And asset-backed markets was nothing in 1985. It didn't exist in 85. And now we're talking about a $2 trillion market here. So a lot has happened in the last 20 years. It's been exciting times for financial markets. And right now we're in the midst of some market turmoil because of that unbridled growth. Now, this is the amount outstanding. This chart shows you the issuance. That is the amount of debt that's being issued at any given point in time. So the first was an example of the stock of debt at any point in time. And now I'm talking about the flow of debt year by year. And you can see that as of 2006, mortgage-related bonds were the fastest growing segment by far. And that continued up until 2007, and then the brakes started being put on to that market. Okay? And you can see over time the growth of these various different markets. And the fact that federal agency securities grew, but mortgage-related securities probably was the fastest growing subject to the asset-backed market as well, which is related. Yeah. Mortgage-related is specifically about mortgages. Asset-backed could be any asset. So for example, consumer credit card loans. You can package that up and sell claims on that. And that would be under asset-backed securities, not under mortgages. So, but they're related, obviously. Okay. So these numbers will give you an idea of what's out there, what's significant, and what's not. This gives you a sense of the amount of trading that goes on. While these securities are large in size and large in flow, they are not that large in terms of transactions. So unlike stocks that trade all the time, we don't have an organized US bond exchange like the NYSE, where people trade bonds every minute of the day. There are bonds being traded every minute of the day, but they aren't typically the same ones. Whereas I would argue that Microsoft and Google are traded every minute of the trading day. So typically bonds do trade, but they don't trade on organized exchanges. And that makes them less liquid. Even the very, very safest and most liquid bonds do not trade as frequently as equities and futures. So the liquidity characteristics can be very, very different for these instruments. And these complex securities, like collateralized debt obligations, mortgage-backed securities, they trade even less frequently because they are highly complex, and it's not that easy to figure out what their prices are from minute to minute every day. Now, the fixed income market participants that we're going to be focused on fall into three groups: issuers, intermediaries, and investors. Issuers, of course, are the end users of these instruments. They include everything from governments down to foreign institutions. These are the folks that issue pieces of paper that are IOUs, and they get cash in return for that to finance their operations, and in return they pay interest. Okay? The investors, of course, are the folks that are buying the paper or essentially providing loans. So every once in a while when I go out with my colleagues for lunch in the finance group, one of my colleagues will say, "Can I sell you a bond? I didn't go to the cash machine today, and I need you to help me finance my lunch." These are how finance professors speak. And unfortunately, the idea about buying somebody's bond is you're lending them money, right? So instead of saying, "Can you lend me $5?" we have to say, "Well, I'm going to issue a bond. Can you buy my bond?" The investors are the ones that are loaning the money to the issuers, okay? And these include, as I said, governments, pension funds, insurance companies, banks, hedge funds, and so on. In the middle of all of this are the intermediaries: primary dealers, other kinds of dealers, investment banks, the credit rating agencies, the credit enhancers. What do I mean by credit enhancers? Folks that help credit markets by providing insurance to the credit, like private mortgage insurance, and liquidity enhancers. These are the counterparties that try to bring buyers and sellers together to increase the liquidity of the markets. The dislocation has been going on in the intermediary sector, and of course, the issuers are having some difficulties now because they're going to have to make good on these kind of claims. And the people that are going to be hurt ultimately will be the investors who are holding pieces of paper that may not be worth as much as possible. And so the efforts now at trying to shore up the finances of Fannie Mae and Freddie Mac, Lehman, Merrill, and all of these other institutions is really aimed at trying to help out the combination of the intermediaries and the issuers. Because if you don't help out this group, then what happens is that this group is going to get hit. So Lehman Brothers, for example, is an intermediary. They are one of the biggest dealers in these kinds of securities. Merrill Lynch, is also one of the biggest dealers in these kind of securities. As dealers, they end up taking exposure on their own books. That's not a great idea in general, because the best of all worlds is you're the toll collector that's collecting tolls for traffic going back and forth and back and forth. You don't take any risk. But if not everybody wants to go back and forth and back and forth and back and forth, you might stand ready to do one side of the business and let other folks do the other side of the business. But if you're not careful in laying off your exposure, you can end up getting hurt pretty badly. An example of this that happened in equity markets in 1987 was when the stock market crashed. That was a very serious event on October 19th, 1987, where in one single day, the US stock market lost approximately 20% of its value in one day. Now, that's a serious dislocation. We're going to talk about that this Friday when we run this trading game. I'm going to have all of you engage in trading over a very short period of time, so you're going to be under tremendous pressure as well. You tell me how easy it is to think on the fly. What happened on that morning of October 19, 1987 is that the specialists, the dealers who are supposed to be making markets, their job is to buy when everybody wants to sell and to sell when everybody wants to buy. They got it there in the morning at 9:30 and were overwhelmed with everybody wanting to sell. So they ended up buying, the specialists. And they bought, and as they bought, what happened to the price? Kept going down. That means more people wanted to sell, so they kept buying. And as they bought, what happened? Price kept going down. And it kept going down all the way, so the stuff that they bought in the morning was worth 20% less in the afternoon. And these market makers will also use leverage, so many of their capital bases were wiped out by that 20% decline in a day because they were just doing their job. In fact, there was a story about the floor of the New York Stock Exchange was literally packed. I mean, it was tighter than a Tokyo subway train during rush hour. Okay, it was packed. I mean, literally, you were elbow to elbow against others. Unfortunately, one of the market makers had a heart attack around 1 or 2 o'clock. And he wasn't able to fall to the ground until the market closed at 4 because he was propped up by everybody else, desperate to try to transact. And he died. And somebody who was near him said, look, I knew the guy was in trouble, but what was I supposed to do? I was 100,000 shares long, and I had to unload my portfolio. I mean, they were trading. That's how desperate it was on that day. So this kind of intermediation can be extraordinarily high pressure. And when you're engaged in an unwinding of portfolios, dislocation can occur. So we're seeing that right now play out. And it's a little different because we're dealing with fixed income securities, so I'm going to come back and talk about that. Okay, that's the background to what we're going to study, these fixed income markets and fixed income instruments. I'm going to ask you to read Brearley and Myers so that you can get up to speed on institutional details, and there are quite a few, so I would urge you to please do that reading and make sure that you understand the basic terms of these markets. What I want to talk about, though, is the framework. I want to give you a framework for thinking about valuing fixed income securities. And really, as I said, it's a framework that you already know. You already have that in your mind. I've already changed the way you think about financial markets by asking you to focus on cash flows and timing and the time value of money. That's all you need in order to value fixed income securities. The rest is just institutional detail, which, while very important, is not something that we need to worry about in class, but I'll leave to you to focus on. So let me give you an example of valuation and how to do it. It'll be a very short one. You all know how to do this. We've got a cash flow, a sequence of cash flows for a particular security that I'm going to call a bond. And in particular, I'm going to call this a coupon bond. Now, with a coupon bond, there are two things you need to know. You need to know what the coupon is, and you need to know the maturity, how many dates that it pays off. One of the institutional details that you'll need to know is that coupon bonds typically pay semi-annually. Some coupon bonds can pay quarterly, But most of them, as a matter of convention, pay semi-annually, but that changes depending on the market. So you'll need to learn a little bit about those kind of conventions. I'm not going to worry about that, and I'm going to abstract from that and simply say that here's a 3-year coupon bond that has a principal of $1,000. That's the typical principal or face value that a bond comes with. So this piece of paper is an IOU, and it says I owe you $1,000 at the end of 3 years. Okay? But I'm not going to pay you just $1,000 at the end of 3 years. I'm going to pay you $50 every year for those 3 years. So the coupon is a 5% coupon. So when you hear of a coupon bond, that's a 5% 3-year bond. That term that I just uttered means that it pays off $1,000 at the end of 3 years, and in the interim, it pays off $50 a year as its coupons. Why is it called a coupon bond? In the old days, the bond was actually a piece of paper, and on the bottom of it were little coupons. And you'd clip the coupons and mail them in, and once a year when you mail them in, or twice a year when you mail them in, you get back $50. Okay? Nowadays, it's all done electronically. So first thing you do, in order to value the cash flow, draw a timeline. Okay? We're here sitting at date 0, that's today, and you've got 3 years to go. 1 year, 2 year, 3 years. At the end of 3 years, you get paid your principal, $1,000, plus the coupon. There are 3 coupons for 3 years. And so at the end of this bond, when the bond matures, you get paid $1,050, and then 50, 50, and here we are at date 0. Question, what is this worth? Yeah?
It depends on the interest rate.
Right.
If the interest rate is exactly 5%,
Yeah.
so it's worth just $1,000, say.
Right. If the interest rate is 5%, it's worth $1,000 today. If the interest, right, that's par. But if the interest rate is worth less than that,
So it's worth more than 1,000.
right, and if it's worth, right, exactly. So in general, how do you figure out the price of this thing? Yeah, Vita. Well, no, I was asking a somewhat different question, which is how do I figure out the market value of this bond today, times 0? Yeah, compute the net present value, NPV. That's one answer that was the correct textbook answer. What's another answer of how do I figure out the market value?
Go to the market.
Exactly, auction it off. How many people want to pay me $1,000 for this today? No, 1,001, 1,000 and whatever. We can auction it off and figure out what the price is from the market. But in fact, what we're doing by doing so is computing the present value. And the way we're doing it is by figuring out what the price of $1 is in date 1 today, what the price of $1 in year 2 is today, and what the price of $1 is in year 3 today, getting those exchange rates, and then converting all of those different currencies to dollars today, right? We know this. We've done this many times. So the way that you figure out valuation, the way that you figure out valuation is by using discount rates that we get from the market and applying them to compute present values, right? Very simple. So really, the components of valuation for bonds, if there's no uncertainty, you already know. We've done it. That was last lecture. And for special cash flows like annuities and perpetuities, we've got closed form solutions, formulas that you can program up in Excel to figure out. The kind of risks that we're going to focus on later on in this lecture and in the lectures after we talk about uncertainty is inflation risk. We talked about that, right? The fact that when you buy a bond or you sell a bond, if the purchasing power changes, that's going to introduce a new kind of unknown that we need to grapple with. Credit risk, that's a major form of risk that we're dealing with in financial markets today and that we're likely to be dealing with for years to come. You might like to borrow from me or lend to me, but what about credit issues? How do you know that I'm still going to be around a year from now or 2 years from now? Timing, which we'll come back to a little bit later on, liquidity, and then of course, what currency. If we're doing international borrowing, we have an extra dimension of risk, which is fluctuations in the exchange rate, okay? So for the next couple of lectures, I want to keep life simple and talk just about riskless debt, riskless in terms of default. So in particular, I'm going to be talking about US government bonds, all right? And I'll come back to risky debt later, but for now, let's just focus on the debt that will not default, because you can always print up dollars to pay off your creditors, right? Those dollars may not be worth as much as you would like them to be if you do too much of that, but for now, we're not going to focus on default. Okay, so the first kind of bond that we're going to try to price is what's called a pure discount bond. This is a bond that is different from a coupon bond in the sense that there are no coupons. So it only pays off one payment at the end. And the reason it's called the discount bond is because it is what it sounds like. The price of the bond today is going to be at a discount from the face value. If the face value is $1,000 and there's nothing in between, then the price of the bond today can't be greater than $1,000, right? Because money today is worth more than money next year. So the price today is going to be lower than $1,000. It's going to be a discount over $1,000, hence the term pure discount bond. Now, there are pure discount bonds out there. US Treasury bills are examples where there's one payoff at the end and nothing in between. But a while ago, financial engineers came up with a rather brilliant idea, which you may not think is so brilliant because it's so painfully obvious. The government issues coupon bonds as well, and typically for longer maturities, like 5 years, 15 and 30 years, there are no pure discount bonds for those longer maturities. When the government issues them, they issue them with coupons. But you can imagine a situation where somebody would like to have a discount bond for 30 years. And so some clever financial engineer said, hey, here's what I'm going to do. I'm going to buy up a lot of these Treasury coupon bonds, and I'm going to issue discount bonds that match exactly the coupon payments from my Treasury bonds. In other words, I'm going to take the coupons and strip them and offer them up as separate securities. And I'm going to call these strips. And these strips, which stands for separate trading of registered interest and principal securities, created a huge market for essentially what are government bonds, but that have been pre-processed in a relatively simple way. Now, this didn't happen that long ago. Maybe, I don't know, 15 or 20 years ago, they created strips. So this is why I'm so excited about financial markets and why I think all of you have tremendous opportunities. It's because there are so many ideas that may seem obvious to you, but are not obvious to the market. And there's no patent on good ideas. There's no monopoly on good ideas. You can actually create tremendous value by coming up with what you might think of as so simple a solution, but that solves problems for very large financial institutions. Now, how do we price these things? Well, this is just a one-liner. The price of a discount bond is simply equal to its face value, discounted to the present by the appropriate interest rate. That's it. Pure and simple. We're now done with pricing pure discount bonds. There's nothing else to it. Okay? It turns out that this is a really wonderful relationship, because if you've got two of these three variables in this equation, you've got the third. If I tell you what the face value is and what the interest rate is, you've got the price. If I tell you what the price is and what the face value is, you've got the interest rate. And if I give you the interest rate and the price, you can actually figure out what the face value is. All right? So this relationship is going to be very handy when we look at the prices of these instruments and we want to now infer what that says about what's going on with interest rates. In fact, what I'm going to show you next time is that when we look at the newspaper and we take a look at the prices of discount and coupon bonds, Implicit in those prices is a forecast of the future. This is as close as any of you are ever going to get to a crystal ball. I'm serious. By looking at prices, you can tell the future. You can't do it perfectly, but neither can Gene Dixon or any of the other astrologers, right? The point is that this is our way of figuring out the collective intelligence of all market participants and what they think about what's going to happen. And because of that kind of market knowledge, I can tell you that with 99.5% confidence, tomorrow the Fed will cut its interest rate. Now, how do I know that? I don't know that. The Fed may not. But if you look at financial markets today, if you look at Treasury prices today, if you look at the Fed funds futures today, all of those prices, if you know how to read them, if you can decipher those tea leaves, it will tell you that tomorrow the Fed will cut rates. So I want you to watch tomorrow to see if I'm right. Okay? It'd be very embarrassing and potentially catastrophic if I'm wrong. So listen carefully. Any questions? Yeah.
On that second, I saw something on the podcast this morning that was saying that if they did do that,
Yeah.
but later down the road they have nothing to hold.
That's right. In other words, if they cut rates tomorrow, then they're going to be shooting one of the very few remaining bullets that they have. The question is, if a bear is charging at you and you've got one bullet left, you're probably going to use it anyway, right? So why don't we return to this issue on Wednesday since we're out of time. All right, thank you.
The following content is provided under a Creative Commons license. Your support will help MIT OpenCourseWare continue to offer high-quality educational resources for free. To make a donation or to view additional materials from hundreds of MIT courses, visit MIT OpenCourseWare at ocw.mit.edu.
Now, also, before I begin today's lecture, I want to comment a bit about what's going on in the news, because at last time, on Monday, I said that the Fed was going to cut rates. And in fact, if you looked at the data on Monday, and you looked at things like the Fed funds future and other financial contracts, the market had priced in the fact that the Fed was going to cut at least 25 basis points, and actually a reasonable probability that it was going to cut 50. And of course, they did neither. They actually held rates steady. But they did do something. What did they do? Anybody know? Yeah. How large a loan? $85 billion, which even among friends is a lot of money. Now, this is yet again an extraordinary and unprecedented measure. We know that the Fed did backstop Bear Stearns, but the Fed didn't spend any direct money on Bear Stearns. They basically got JP Morgan to buy Bear Stearns and negotiated the deal. In this instance, the Fed is lending money to AIG, lending $85 billion, and AIG isn't even a bank. So what do you think is going on? Does that make sense? What does that tell you about what's going on in markets? The fact that everybody thought the Fed was going to cut rates, and they didn't, that shows a certain kind of restraint. In fact, I think it was this class that somebody mentioned, well, rates are already down at 2%. How much more can they cut? I mean, if they cut 50 basis points, that leaves them very little flexibility. And also, if you think that the reason we are in this crisis is because borrowing has been so low for so long that people have been going out and making all these bad loans, and they shouldn't be doing that to begin with, cutting rates is not going to really help that situation, but can only encourage it. But nevertheless, there was a crisis. Certainly over the weekend, we had some very bad news. Lehman Brothers went under, and the Fed did what? Nothing. So if the Fed did nothing for Lehman, yet they extended an $85 billion loan for AIG, something's got to be different, right? I mean, I guess you could see whether or not Ben Bernanke has a brother-in-law working at AIG, but I don't think that's it. Yeah.
But today you report that Barclays is actually going to go ahead and buy. So what changed?
Well, Barclays, the announcement is that Barclays is buying some of the U.S. operations of Lehman Brothers. They are cherry-picking the operations that they want. What Lehman tried to do over the weekend was broker a deal where Barclays would buy all of them and assume all their obligations and allow them to keep on going as a going business concern. Barclays couldn't do that because they couldn't get shareholder approval quickly enough, and also ostensibly because the Fed would not backstop any losses that Lehman had hidden in its books. And in a matter of 48 hours, it's kind of hard to figure out all the buried bodies in an organization as complex and as large as Lehman. But Barclays is going ahead and purchasing those units that they like. And there are many units at Lehman Brothers that are extraordinarily profitable, very good businesses with excellent people. So Barclays is going ahead with those. And by the way, there are all sorts of other sharks that are swimming around Lehman, cherry-picking various different groups. This is part of the problem with this kind of financial distress. We're going to actually get to this at about lecture 18. We're going to talk about financial distress, and I'm going to bring you back to Lehman Brothers and ask you to think about the problems that this company faces. Because think about it, now that it's been announced that Lehman is liquidating, well, let me put it to you this way. Suppose you were working at Lehman Brothers, and suppose that you've been there 15 years, and suppose that you were running one of the most successful proprietary trading groups at Lehman Brothers, and now this news comes up and it's a surprise to you. What is your first reaction? What are you going to do? Yeah. Right. That's certainly one thing. You're going to take a look at what your positions are. And then after you establish that you're okay in terms of your trading positions, what's the next thing you're going to do? What are you going to start thinking about? Yeah.
Start clicking your resume.
Exactly. You're going to start looking around. So you're going to talk to lots of other people about maybe moving your entire group of 15 people that you've handpicked and developed over the last 15 years. And you're going to start talking to all sorts of other counterparties to move your entire group. And now Barclays decides to buy Lehman, the operations that you're a part of. But there's no slavery in the United States, at least not since the 1800s, which means that if you want to walk, you can. So if Barclays buys Lehman and buys the group that you're in, and you're one of the most profitable parts of that, you don't have to stay. So in addition to paying for Lehman, Barclays is also going to have to talk to you and get you to stay, which means that they're going to have to pay you an extra bonus and all of your people bonuses to stay. So now the price of having to keep Lehman together has just gone up dramatically because you've got to keep all of the talent, and it's very hard to do that. So the fact that Lehman is in trouble has caused all sorts of problems and will create additional amounts of frictions and payments that otherwise wouldn't have had to be. So I want you to keep that in the back of your mind, the costs of financial distress. We're going to come back to that in about 10 lectures. Okay, so yeah, question.
I heard a quote with regards to the Fed action that the Fed decided that the problem is not the cost of money, but the supply of money.
Yeah.
And so they're going to infuse capital into the market. Is that just referring to the AIG 85 billion, or is there some other way that they're infusing capital?
No, I mean, that's certainly one way, but the other way is that they are allowing the other banks to borrow from them at a lower rate. So the discount window that typically banks go to borrow from the Fed, they're making more money available in that way, and other central banks are doing the same thing, injecting money into the system in order to calm the fears of individuals.
Does that lower the effective interest rate?
Well, we're going to see that in a minute. We're going to actually, one of the things I want to talk about today is exactly what do we see from market prices. Now, on Monday, I claimed that market prices was telling us there's going to be a Fed cut. Clearly, it was wrong. Now, that's a very good lesson because what this is telling us is that market prices have information. But as I told you last time, they're not a crystal ball. They're not perfect. And so they can be wrong. Apparently, and this is now very speculative, apparently the Fed decided, as you pointed out, that it's not the availability of, or rather the cost of funds that's important, but rather the availability. In other words, they're worried about a credit crisis, a crisis of liquidity. And AIG is a very important player in that respect, apparently much more so than Lehman, because Fed didn't do anything to try to keep Lehman from going under. But an $85 billion loan was what they decided was appropriate for AIG. The reason for that, the ostensible reason, who knows what the real reasons may be, but the reasons that we think this happened is that AIG provides enormous amounts of insurance to a variety of other players in the credit markets. And if they go under, if they decide that they can't make good on those insurance claims, what happens is that those investors that are holding the paper that is backed by subprime assets and that are insured by AIG, once the insurance disappears, they are obligated, a number of them, to sell those pieces of paper. If you're a pension fund, you are obligated to hold only investment-grade assets. If it turns out that, for any reason, those assets become lower than investment grade, and we're going to talk about this at 4 o'clock today at that pro seminar, if it falls below investment grade, by law, you are obligated to get rid of those assets. Now, what do you think would happen to the market if everybody all at once decided to get rid of those assets? Right, and then there'd be a mass panic, right?
I just have, there's something simple that I don't understand. How can the interest rate go below the inflation rate?
Well, it's not supposed to for any extended period of time, but for any short period of time, it certainly can. What it says is that the real rate is negative or that the economy is contracting.
So like right now, $1 a year from now is more valuable than $1 today, right?
Well, if you take inflation into account, yes, in real terms, not in nominal terms. You can never have a negative nominal interest rate, right? Yeah. Unless somebody's burning dollar bills. But let me hold off on that because I want to actually, that brings us back to the end of last lecture. What I want to do today is I want to talk about information specifically contained in interest rates. And we're going to actually take a look at what the short-term interest rate is. I think you'll be kind of surprised to see what the 3-month T-bill rate is as of today. Anybody know what it is? You seen it? 2%? No, it's lower. We'll see in just a minute. Okay, so let me start today's lecture by going back to where we left off last time. Last time we talked about the pricing of pure discount bonds, bonds that pay only principal at the end and no intermediate coupon payments. And we saw that the price today is simply equal to the face value or principal at the end of the maturity date and then discounted back using the interest rate. And I pointed out at the end of last lecture that the interest rate can differ depending on the horizon. So a 1-year interest rate is not the same as a 5-year interest rate because the market has different expectations about how the economy will do and what the appropriate borrowing rate or the time rate of preference might be. So in fact, for every horizon, 1 year, 2 year, 3 year, 5 years, we have a different interest rate. It doesn't have to be different, but in general, it does tend to be different. How do we find out what these interest rates are? Yeah.
Market.
Exactly, the market. The way to do it is not to think about interest rates at all, but rather to auction off pieces of paper that pay $1,000 in a year, $1,000 in 2 years, $1,000 in 3 years, and so on. And we auction off each of these pieces of paper and see what the prices we fetch are for those pieces of paper. Once we have the price, and once we know the face value of $1,000, we can back out the interest rate. We can solve for the interest rate R, okay? So that's how we get the rates. And what I want to do today is to explicate what those rates really mean. I want to show you how to read the entrails and see that these rates contain enormous amounts of information about the future. Not all of that information is good, so sometimes it's misleading and incorrect, but it's always useful in one form or another. Now, to do that, I want to develop a little bit of new notation and get you to think yet again differently about the evolution of interest rates over time. I'm going to define what's called a spot rate as the rate of interest between today and some other point in time. And I'm going to talk about future spot rates as the interest rates between some future date and then another date even beyond that. So to be explicit, I want to define new notation called capital R. Uppercase R is meant to convey a 1-year spot rate of interest at a particular point in time, t. Okay? So capital R1, that denotes the spot rate of interest between today and next year. Capital R3 denotes the spot rate of interest between years 2 and 3. And capital RT denotes the 1-year spot rate between dates t minus 1 and t, okay? So these capital R's are always 1-year rates, unlike the little r's, which can denote multi-year rates, depending on the application. Now, there's a reason I want to define these big R's. It turns out that if I have a 1-year a pure discount bond that pays off at year t, then I can use the 1-year spot rates to compute today's price, right? The 1-year spot rate, when you accumulate them, when you multiply them together, that will give you the accumulated interest over this entire t-year period. So if I want to discount the face value f and bring it back to year 0, I can just assume that there exists one rate, or I can say, you know what, if there's multiple rates that differ year by year, I can use those individual rates. Okay, so I get that first equation. Now, we don't observe them, so this is a pure fiction in terms of what I'm writing down. It's a theory. So I'm not telling you that we know what those big R's are, but I know that they exist, and whatever they are, this is what the price of the bond ought to be today. Any questions about that? Okay. Now, what I do observe is the price and F. Those things I get from the marketplace and the contract for these bonds. Therefore, it turns out that as a very simple identity, this expression, this little r, which I'm adding some little more complicated notation to indicate when I begin and when I end in terms of my horizon, I can simply define this little r as being equal to the geometric average of these big R's. It's really just terminology at this point, right? I'm simply saying that in reality, we have 1-year interest rates that may change over time. And I know that the price of the bond today is equal to the future course of 1-year interest rates as discounts over that period. When I use those as discount rates, I bring back this value f, I get today's price. I can just as well write that chain of 1-year interest rates as a single number raised to the tth power. I can always do that, right? You could think of this little r as an average, a geometric average of the big R's, right? So the strict definition is going to be little r is going to be the tth root of the product and then minus 1. That's what the little r is, all right? You take that product and you raise that to the 1 over tth power, or take the tth root, and then subtract 1 from that. That's what my little r is. Now, why am I going through all of this? It's because I want to show you that from a theoretical perspective, the little r, which we can observe, contains information about the future course of interest rates, right? Within the little r are all the big R's, at least today's expectations of what those big R's are going to be. So it turns out that if we look into the little r's, we can actually develop insight about what's going to be happening next year, 5 years from now, 30 years from now. Now, let me give you an example just to make sure that we understand the mechanism by which these little r's and big R's are determined, okay? So here's a set of prices of strips. These are Treasury securities issued by the US government, and then a third party buys them and then takes the coupons and creates separate securities and sells those separate securities, each one of which is one of these coupons. So from our perspective, they look like pure discount bonds. There's no intermediate coupon payments for each one of these strips. And the maturity is 3 months, 6 months, 1 year, 2 years, up to 30 years, okay? And those are the prices. So a 3-month strip is currently priced as of August the 1st, 2001. It was priced at a little bit less than $1. Okay? So how do we figure out what the little r is associated with those various prices? Well, let's take an example. The 5-year strip is priced at about 80 cents to the dollar. Okay? So the price is 0.797, and that's equal to $1 paid 5 years later. So therefore, it's $1 discounted back 5 years. So I'm going to use my little r, and the 0,5 indicates that it's today's spot rate for borrowing over a 5-year horizon. And it turns out that when I solve for that, I get a number that's 4.64%. That's the rate of return, the cost of capital, the yield of that 5-period horizon. Okay? Any questions about this? Yeah?
How would we do it maybe if it was one that was less than a year's time horizon?
So if it's less than a year's horizon, then you basically have to go the other way in terms of the power, right?
Is it like 1 over 1/2?
Yeah.
Or basically?
Exactly.
You square.
That's right. Yep, that's it. It's just a shorter time horizon than a year. Now, suppose that we observe a bunch of these, as we do with the strips. So in other words, you've got a 5-year rate, you've got a 10-year rate, you've got a 2-year rate, and so on. What does that tell us about the future? Well, let's write down the big R's. Even though we don't see them, we know that somehow implicitly they're there. So what are the relationships between the little r's and the big R's? Well, you'll see something really neat emerge out of this. So we'll start with a 1-year strip. With a 1-year strip, the little r and the big R is the same, right? Because it's only 1 year. So there's a 1-year big R, a 1-year little r, and when you work out the math, they're actually equal to each other. But now, when you go with 2 years, 3 years, and t years, it gets a little bit more complicated. Take a look at what happens if you take the price of the 1 year and you divide that into the price of the 2 year. So these two securities, the 1 year and the 2 year, they have the same F, the same face value. They pay $1,000 at maturity. But one of them goes for 1 year and one of them goes for 2 years. What happens when you take P01 and you divide that by P02? By the way, both of those prices exist today, right? For example, if you take a look at the strips, the price of P01 is 0.967. The price of P02 is 0.927. If I take the price of 1 divided by the price of 2, what do I get? Yeah. Exactly. I get 1 plus R2. And so if I subtract 1 from that, I get R2. So let's just go back. I don't have a calculator with me, but I'm sure all of you do. Somebody do that division for me, will you? Can you take 0.967 and divide that by 0.927? What do you get? 0.967 divided by 0.927. What's that? 1.04, and then subtract 1 from that, 4%. Actually, can you give me a few more digits of accuracy?
4.014.
What's that?
4.314.
4.314. So it turns out that in year 0, where we have all of these prices, we actually have a forecast for what big R2 is. Big R2 in this case is the borrowing cost between year 1 and year 2. But we're sitting at year 0. So implicit in the price of a 2-year bond and a 1-year bond, implicit in that is a forecast of what the price is going to be, or what the yield is going to be, or what the borrowing cost is going to be between years 1 and 2. In this case, 4.3% or so. And that's a really important observation. If you plot these little r's on a graph as a function of time, you actually get a sense of where the future big R's are going to lie. This plot, a plot of the R's as a function of time, is known as the term structure of interest rates or the yield curve. And it gives you a sense of where future interest rates are going to go. If the curve is upward sloping, it says that as you go out into longer maturities, your average yield, the geometric average of all the big R's, it's getting bigger as time grows, as the time horizon grows. If it's downward sloping, it suggests that future interest rates, future big R's, are declining. So I want to show you what this yield curve looks like today. Now, it turns out that we don't have a yield curve of strips as readily available as a yield curve that includes coupon payments. So I'm going to come back to the distinction a little bit later on. We haven't talked about coupon bonds yet, but I just want to show you what the yield curve is. So I'm on the Bloomberg website. This is publicly available, so I don't have a particular license for it. It's the public version. And if you click on market data and then click on rates and bonds, you're going to get this page right here. So these are the different US Treasury securities, the different horizons. These are the coupons. For less than a year, there are no coupon payments, so these are pure discount bonds. And there's the graph. That's it. That graph, the green line, is showing you the future course of interest rates. It's extremely low today. The scale is on the left-hand axis. And by the way, these are in percent. So where we are today for a 3-month rate, it's close to 0. It's actually 3 basis points. 3 basis points for a 3-month T-bill. What is that telling you? What's the relationship between price and this little r? Yeah.
People want cash today. They want it in 3 months.
Well, that's right. But how does that yield get so low? Yes? The price is extremely high. That's right. Price is equal to the 3-month payout divided by 1 plus little r. If little r ends up being really, really tiny, it's only because the price is really high. Why would the price be high?
Because U.S. Treasuries are the only safe thing to own right now.
At least that's what many people think, exactly. There is a really strong flight to liquidity going on in markets as of today. And how do you know that it's as of today? Well, take a look at the difference between the green line and the orange line. The orange line was what it was yesterday. You see that there's a difference. There's a noticeable difference on the short end. That means a lot of people are out there buying Treasury bills now, probably as we speak. Maybe you ought to go and buy some Treasury bills. People are scared. And they're scared because of all the things that are going on in the news. And this is exactly what the Fed is trying to stave off. So you're absolutely right. The Fed is not worried about the cost of borrowing. They're worried about whether or not there's money out there to be able to calm the fears of market participants. Yeah?
Do you think also the jump from 2 days ago to today is partly not, the Fed didn't cut interest rate once, but in their notes, they highlighted that in the near future they might have to.
That's right. They might have to. So that expectation actually is built into these prices. The market recognizes that, and they're worried. But think about that. If the Fed has said that they're going to be cutting rates, possibly cutting rates in the future, and yet the rate stays high going forward, relatively high, and rates go down today, what that's telling you is that the market is being driven by a panic reaction. Now rates are going to go up. So the fact that you see the market determining a yield curve that's upward sloping, that's telling you that people expect that rates are going to go up, that rates have to go up for one of 2 reasons. And in fact, you can take a look at the steepness of the yield curve as telling you what the market's expectations are for how quickly rates are going to go up and where they're going to go up. So you have to look at the x-axis a little bit differently. These are denominated in years. So this is 3 months, 6 months, 1 year, 2, 3, 4, 5, up to 10, then 15, 20, and 30. So these are long-term rates. And you can see that the yield curve really goes up sharply after the first 3 months. There's a big increase in the slope, and then it becomes a little bit more gradual. That's a sign of a short-term flight to quality or flight to liquidity, but that the market expects over time, as things calm down, that interest rates will go up for one of two reasons. Either there are inflationary pressures, and that will drive rates up, or there's going to be some economic consequences of what's happening today, and that will ultimately cause rates to go up. Yeah.
So, what's happening with the interest rates outside of the States? Because I'm from Argentina, right? And when we have crises, in general, interest rates go up because the probability of default increases. And now I see here it's the other way around because sort of
it depends.
Not considering it will be.
That's right. It depends on the nature of the crisis. So in certain countries where there is a financial crisis, the typical reaction of monetary authorities is to flood the market with cash, because that's their reaction to a liquidity crunch. They want to reduce the prospect of having a kind of run on the banks. So they'll flood the market with their currency. When you do that, you encourage inflation, and that's why interest rates go up in those kind of economies. The US, for better or for worse, has shown a certain degree of monetary restraint over the years, in that while they do certainly cut interest rates, and Alan Greenspan was very active in this respect over the last 10 or 15 years, the fact is that there's been more measured control of monetary policy in the United States. So what that means is that this is a symptom more of a short-term cash crunch. People are just putting money in Treasury bills for the short term without any expectation that the Fed is going to dramatically increase the money supply. If they did that, you would then see interest rates rise because inflation would be much more of a problem. Okay, yes?
Normally, I thought, for example, the European Central Bank normally raises the interest rates to prevent inflation rather than to.
That's right, they do raise it. And that's one of the reasons why the Fed did not cut it. It's because they are concerned with inflation. And so if they ended up cutting interest rates, while that might stave off certain credit crunches, that would actually encourage inflation.
So inflation does encourage higher interest rates, but when is the bank that...
Inflation causes, so I see the confusion, and let me make a distinction. There are two different interest rates that are going on. There's the market rate of interest, which is what this is, and then there's the Fed's stated federal funds rate, which is what it charges its other banks, member banks, for borrowing. The Fed is able to control what it charges to other banks. The Fed cannot control these rates. So the interest rates that you're thinking about, that, for example, when the ECB raises rates, they do so so as to discourage lots of borrowing and lending and reduce the amount of money that's in the that's in circulation, and that decreases business activity, which then reduces the pressure on inflation. Okay, so that's what they do in response. But they don't control the interest rate determined by the market for Treasury bills. And in these interest rates, these 30-year rates, as opposed to the overnight borrowing rates and Fed funds rates, these rates give you a sense of what the market is expecting over time. Megan, do you have a question?
The Fed, as it cuts its rate, hasn't really had an impact, or hasn't had as much of an impact as it would have wanted on the actual banks, the spread over time, or whatever the banks were charging commercial customers. So, the mechanisms that they used to.
Right.
To stave off that credit crunch, that's really good.
Well, that's right. I think that when you think about the instruments that the Fed has for managing monetary policy and credit and liquidity, it's actually pretty minimal. I mean, they have like one variable. Imagine flying an airplane and you get one control. You pick the control. You want to be able to control the wheels or the ailerons or the, it's very, very hard to try to manage the economy with one variable. Now, the Fed has other policy instruments that are a little bit more complex, like the discount window, like moral suasion. The New York Fed can go to these banks and say, what are you guys doing? Are you nuts? But what's going on now is that because the crisis has reached such an extraordinary level, they're not worrying about interest rates. They're actually trying to figure out how to stave off some kind of mass panic. And so getting directly involved with AIG, getting in discussions with Bear Stearns and JP Morgan, they really have no choice. And it's a signal of sort of how desperate times are. Yeah, one last question.
A couple, this is kind of a multi-part. My understanding is first that the Fed is not a federal organization. It's made up of member banks.
Yeah.
So that it's not a government entity, but the government has appointed representatives to it. And on the same time, where does the Fed get all their money from?
Well, so this is more of a question that you probably should be asking your macro instructor, but I'm happy to answer, but the macro folks may disagree with what I'm about to tell you. The Fed is a government organization. It's separate from the government in the sense that it's not a political organization, but it does have the full backing of the government, and it has powers granted to it as part of the various legal proposals that were developed to create the Federal Reserve System. Where does the Fed get its money from? It gets its money from the Treasury. So the Fed can actually engage in what are called open market operations and can actually contract or expand money supply based upon what the Treasury will allow it to do or will work with it to do. So, and the Fed controls the borrowing rate among all of the member banks. And actually, all of the major banks are members. So it's not like you can start up your bank tomorrow. In order to start a bank and deal with the public, you need a bank charter. And the bank charter is issued by the government. And once you're part of that network, you are part of the Federal Reserve System.
So aren't they losing money from, say, the fallout of these banks?
Yes.
Aren't they, in essence, losing also themselves?
Well, they're not trying to make money. That's not their objective. And if they're losing money, ultimately, it's not them that is losing money. It is who? Yeah, we're losing money. It's government sponsored. So that's one of the reasons why I think the Fed has been so concerned about bailing out Lehman Brothers, and even the bailout of Bear Stearns, which did not necessarily cost them anything. The fact that they were willing to provide this backstop guarantee in order to make the deal happen, that implicit insurance is a cost that we ultimately end up paying. They got a huge amount of heat for that. And that's one of the reasons why they decided to back off from the Lehman Brothers deal. It's because they would have gotten huge, huge backlash from that kind of an event. Now, AIG, the fact that they went and did something there tells you something about how important AIG is, or what repercussions might have come about if they had let AIG fail. So that says more not about the Fed, but more about the situation with AIG and the specific financial transactions that they were engaged in. Okay, let me continue on, and sorry, I'm going to hold off questions for a little bit longer, but I do want to cover some additional material. So this is the expression that we just described for getting a sense of future interest rates, and we saw, given today's yield curve, that there is some sense that interest rates are going to rise. But it turns out that the yield curve contains all sorts of information, not just about one-year rates, but in fact about multi-year rates. So this is a clear example. This is one example. And it turns out that there's another example that makes this a little bit clearer, which is future rates and forward rates. These are all very confusing terminology unless you sit down and read through it carefully. So I would encourage you all to do that after this lecture. There's a lot of notation in this lecture, not a lot of conceptual challenges, because all the conceptual challenges we derived when we talked about net present value rules. So most of this is just lots of notation and terminology. So let me describe the terminology here. At date 0, if we focus on the price of a bond that matures at time t-1, and at date 0, if we focus on the price of a bond that matures at day t, and we take the ratio of those two, then it turns out we're getting an implicit forecast of the future 1-year spot rate between t minus 1 and t, right? That's just what we did with R2. So this is true in general. And there's a name for this forecast. It's called today's forward rate between dates t minus 1 and t. It is a forecast of the future spot rate between dates t minus 1 and t, okay? We don't know what that spot rate is going to be in general. We don't know what future interest rates are going to be. It's uncertain. But today, implicit in today's prices is a forecast of that unknown future, and we're going to call that forecast the forward rate. So that is really meant to convey that it is a rate that we observe today, and it is meant to capture the market's best guess about what the future spot rate will be, okay? So this is, I know, a little bit confusing, and just to give you a summary of all the notation and terminology we've defined today, we have a spot rate, right? That's a spot rate is the rate that you have to pay or that you will earn on the spot for a period of time. So you've got the 2-year spot rate today. You've also got future spot rates, which you don't know and don't observe. You also have a forward rate, which you do observe today. And the forward rate is a rate that applies over some period in the future. And it's today's best guess of what that future rate will be. Now, we can see the implicit forecasts that are in the yield curve. The 1-year spot rate today also happens to be equal to the 1-year forward rate. However, if you take a look at the 2-year spot rate and compare that with the 1-year spot rate, you can compute the 1-year forward rate for borrowing between years 1 and 2. And similarly, if you compare the 4-year spot rate with the 3-year spot rate, you will be able to figure out what the forward rate is for borrowing 1 year between 3 and 4, okay? Now, you might think this is complicated. Believe me, it gets even more complicated when you think about multi-year forward rates. So suppose I asked you, what is the 2-year borrowing rate 3 years from now? Then what you would do is to take a 5-year bond and compare that to a 3-year bond, and that would give you the 2-year forward rate today, starting in year 3, okay? Lots of different rates. This is, again, why I've told you every time you have a problem like this, draw a timeline. Otherwise, you're going to get hopelessly confused. Now, in general, you can define forward interest rates between any 2 points in time, between time t1 and t2. And so the typical forward transaction is one where today we agree to do a deal that starts at some point t1 in the future and concludes at some point t2 in the future, and that's known as a forward transaction. It's a transaction that we agree upon today to engage in sometime in the future, okay? Now, I want to work through an example because this is a bit confusing. So let me show you how this might work and why the whole idea of forward rates and future spot rates is so important. A practical example is that you are the chief financial officer of a multinational company based in the US. And you're going to get $10 million a year from now from operations overseas. And it's going to come back in the form of dollars. But it's not going to come back today. It's going to come back exactly 1 year from today. Now, you've got to pay dividends 2 years from today. So you're going to use that money that's going to come in a year from now, and then at the end of year 2, you're going to pay it out. And so you don't want to take that money next year and fool around with it. You don't know what interest rates are going to be, but what you'd like to be able to do is to today lock in a rate of return between years 1 and 2, because you know that you're going to need to get that money invested in year 1, and you'd like to be able to pay it out in year 2. And you want to do that all today. So how do you do that? Well, you go to the financial markets and you look at the yield curve and you see what the 1-year rate is and what the 2-year rate is. And what you get from looking at the newspaper is the 1-year rate is 5% and the 2-year rate is 7%. Question, is 7% a spot rate, forward rate, or future spot rate? It's a spot rate of what? Exactly. It is today's spot rate between now and 2 years from now. It's a 2-year spot rate, right? What you care about, though, for the example that I just gave you, is what?
1-year spot rate in 1 year.
Exactly. You care about the 1-year spot rate in 1 year, the future 1-year spot rate, which you don't know what it's going to be. That's uncertain. But you do have the, what rate do you have today? The forward rate, right. You have the forward rate because you've got the 2-year spot rate, you've got the 1-year spot rate. So when you compare the two, implicitly in those two rates is the forecast of the future 1-year spot rate, or today's forward rate between years 1 and 2. All right. Now, let's get to brass tacks. How do you go about locking in the rate between years 1 and 2? Well, here's a really cool transaction that you can do. Today, borrow $9.524 million for a year. How do you know you can do that?
You have the 1-year interest rate.
Exactly. You've got the 1-year interest rate at 5%, so if that's really a market rate, that means that you should be able to borrow at that rate. Okay? So when you're borrowing money, what are you doing? Are you buying a bond? You're selling a bond. You're issuing a bond. Right. Okay. So you borrowed $9.52 million today. Now, in a minute, I'll explain to you why that number is so weird. Then, after you get the money today, I'm going to ask you to put it into the 2-year bond. So you got $9.52 million in cash, and you put it into a 2-year bond. So let's take a look at what you've done with that transaction. The outcome looks like this. In year 0, you've borrowed 9.52, and then you've taken the proceeds and you've bought a bond at 9.52. So in fact, your net expenditures is nothing, right? You borrowed money, you took that money, and you bought something else. You've loaned it out. You've borrowed money for 1 year, and you've loaned it out for 2 years. That's what you've done. So today, you actually have 0 in terms of your assets and liabilities. OK, now let's see what happens next year. In 1 year's time, that 9.52 magically turns into 10. OK? So, but it's a negative 10, meaning you've borrowed 9.52. You've got to pay back 9.52 with interest. How much interest? 5%. That's the 1-year rate. So now you actually have to pay back $10 million. Well, it just so happens you have $10 million. How? From the money that's coming in from your subsidiary, that repatriation amount of money. So you take that $10 million, you pay it back, and you're done with that part of your portfolio. What do you have left? What you have left is a bond that will pay you money in the year after that, between years 1 and 2. And there you go. You get paid $10.9 million. You've done all of this transaction today. You've locked in the rates today. OK? Yeah.
You're locking in the 1-year spot rate 1 year ago?
That's right. You're locking in the forward rate, which is the forecast.
Expected.
Right. It's what the market expects the future 1-year spot rate will be. Now, that's a good point that you bring up, which is, let's say that in year 1, it turns out that at that point in time, the 1-year spot rate is 7%. Are you happy or are you sad? Some people say sad, some people say happy. What do you... If the one-year spot rate 1 year from now is 7%, and you've done this deal already, you're happy. That's right. Because what are you getting on your portfolio? 9%. Now, wait a minute. How do you get 9%? I thought that I told you the 2-year rate was 7%. I'm purposely confusing you, so I'm hoping it works. And then I'm going to try to unconfuse you, and I hope that works too. 5% is the 1-year spot rate. 7% is the 2-year spot rate. Yeah? Right, that's right. The rate between years 1 and 2 is around 9%. And the reason it's got to be that way is the 7% that I told you, that's a 2-year rate, right? That's the average of 2 years. But you know what the rate is the first year? The first year rate is 5%. So if something averages to 7% over 2 years, but the first year is 5, the second year's got to be